All right, quick couple of videos here on Chapter 8 and Perfect Competition. We'll try to tailor them so they're kind of helping you with your chapter questions, your assignment questions. And the first two assignment questions deal with market structures. So the definition of a market structure and what factors are considered in determining the market structure of an industry. And we're going to look at four market structures: perfect competition, monopoly, oligopoly, and monopolistic competition. And we think about, when we talk about market structures, again, we're looking at how they're characterized. So different markets, because they have different types of products, different numbers of buyers and sellers, they behave, and the rules are a little bit different for the interaction that takes place within them. So Chapter 8 is talking about perfect competition. And as I talked yesterday in the lesson, perfectly competitive markets necessarily don't exist, but it's the theory that allows us to understand where all markets kind of fit in on that spectrum. So we're looking at kind of one end of the spectrum, in which monopoly will be on the other side. So the factors that we're going to kind of generally look at is the number of buyers and sellers, the type of product, the amount of information and the type of information, and then the barriers to entry, which these factors combined give individuals some price control. So in a perfectly competitive market, we have many buyers and sellers, and this is important, that no particular or individual buyer or no individual seller can influence market price based on their individual actions. Meaning, if a seller decided to not bring their good or service to market, it would be such a small drop in the bucket that it would not influence market price. If you follow the news at all and you watch about OPEC and oil prices, OPEC is a group of 13 countries, oil-producing countries, that kind of all organize together and operate together. And when they reduce their production or increase their production, it has an influence on the overall market price of oil on the global scale, just because of the sheer volume and size of production that those sellers make up. So not a perfectly competitive situation. Also, we talk about the type of product. So in perfect competition, it's a commodity, or it's homogeneous, or it's a standardized product, meaning that they're all the same. Really, there is no brand preference. Okay, what good comes from seller A versus seller B versus seller C is they're all the same. So there is no brand loyalty, no brand preference, no difference in quality. The good is homogenized. It's the same. Perfect competition has full information of buyers and sellers, so there are no industry secrets. Buyers have all information. They know the price of all goods and services in the market, and nobody has an advantage in terms of information, either production or consumption information. Nobody's getting a better deal somewhere else that's unknown to all the other buyers. And there are very limited, well, in perfect competition we say no barriers to entry, but it's very easy to get into the market when there's money to be made, and very easy to leave the market when that profit margin has dried up. So these are kind of the characteristics of perfect competition. But they apply, these are the general characteristics for all market structures. And all of these determine whether or not an industry or an individual or seller, consumer or seller, has price control. And in a perfectly competitive market, there is no control over price by either buyer or seller. They are what we call price takers. So this is important when we get into what the demand curve looks like under perfect competition. The market price is determined by interaction of supply and demand, the individual decisions of many buyers and sellers. But the demand curve that's facing a single supplier is perfectly elastic, or a horizontal line. And I got a graph in your book that shows this, that market equilibrium, interaction of supply and demand. But once that market price is established, so here in this example, it's $5 per bushel of wheat, looks like. The demand curve that the individual supplier faces is a horizontal line, which means that if this seller, and we had, let's say, a supply curve that was coming in this direction, If a supplier tried to ask for a cent over $5, the demand for their particular goods would fall to zero. That's the idea of that demand curve, because a supplier can essentially sell as much of its good that it wants at $5, an infinite amount. And there will be somebody there to buy it. That's kind of the idea behind perfect competition. So market determined by supply and demand, but once the market price is established, the individual supplier faces a horizontal demand curve at the market price, meaning they can sell as much or as little as they want at the market price, but not any over. And there'd be no reason to sell it for less, because they can sell as much as they want at the $5. There's no competition on price. You have to just take the market price as given. So we call that firms under perfect competition are price takers, right? Firms they face the given market price, and then they have to make the decision on whether or not they produce or not. Okay, they have to accept or take the market price. So what we get into then is looking at, if the market price is at a particular level, okay, how much does the firm produce? Well, we look at the profit maximizing output, because that's the only thing the firm can control, is its output. It has no influence over the price. It just has to take the market price as given. So this is where we get into the golden rule here of business. We look at short-run profit maximization. And when we talk about maximizing profit, we're looking at the place where total revenue, that's the amount coming in, amount of money coming in, exceeds total cost by the greatest amount. Right? That's where profit is maximized. Total revenue is greater than total cost at the highest level. Okay. We've gone through how to calculate profit. That's our total revenue, money coming in minus our total cost. And when total revenue is greater than total cost, we see an economic profit. Total cost is less than total revenue, we see economic loss. So we're going to look at situations or conditions where we can maximize profit in the short run. So I'm going to do another video for this one. Gets a little bit too long, but my next one is going to look at how do we maximize profit. What do we need to understand in order to find the profit maximizing output.